Hello, and thank you for joining us for the latest episode of Discuss with Russ. I'm Russell Rivera, founder and president of Voice Wealth Management. This is episode 23, and my guest today is Ryan Mitchell of Hoboken Tax. Our topic today is last-minute tips for preparing this year's tax returns. For those of you tuning in for the first time, the Discuss with Russ series is focused on helping you get through the crisis and start thinking and planning for what the world might look like as we emerge. We want to help you anticipate possible responses in society's behavior so you can be most prepared to succeed. Voice Wealth Management, my firm, primarily works with entrepreneurs, young professionals, and their families to help them get the most out of their money. While I am a chartered financial analyst and certified financial planner, many also see me as their personal CFO and financial therapist, recognizing the psychological power of money in addition to using short-term and long-term planning to help you get the most out of every dollar you earn and use. Now on to our guest, Ryan Mitchell. Ryan is an enrolled agent with over 15 years of public and private sector accounting experience. His career includes working in public corporate accounting, as well as internal audit. Ryan formed Hoboken Tax LLC in 2012, with a focus on the tax and representation needs of U.S. citizens, entrepreneurs, owners of rental real estate, as well as those in the financial industry. In addition to his tax and representation business, Ryan serves as an NJSEA board of director as well and has chaired the education committee for fiscal years 2018 through 2020. Ryan is also a National Tax Practice Institute fellow. Ryan received his Bachelor's of Science in Accounting with minors in Economics and Legal Studies from Pace University. He's an avid runner as well, having finished 20 marathons through the end of 2020, but 2021, we don't know what it's going to bring. And with that, Ryan, please, welcome to the program. Thanks for being here.
Hey, Russ, thank you so much for having me. I know we've tried to connect a few times before, so it's great to finally connect and make this happen, especially going into this difficult tax season here. And it's going to be one for the ages, especially if Congress doesn't extend the deadline.
And that I think is we'll get to that because I think that's an interesting story that hasn't been here. We're recording this in mid-February, February 12th, which happens to be the first day you can actually file this year, which is late, right? That's later than usual, given among this, right?
Typically, it's like January 22nd, after the Tax Cuts and Jobs Act that got passed in December 17. It was like January 27th. But yeah, this is the latest it's been in my career. Mm-hmm. And they're certainly making some more changes, which could prolong the process. So,
sure. So with the COVID crisis still happening, preparing taxes this year could end up being even more challenging than in past years. I know last year was obviously a challenge, but people had the time to deal with that. Because of all the bills and the emergency measures put into effect last year, lots of different one-time changes were put into the tax infrastructure. So I wanted to take some time, go through some of those that affect individuals and businesses. So let's start with the stimulus checks, right? If someone happened to receive them, how does that affect their tax liability this year?
Okay, so the stimulus check is a refundable credit. So for under individuals under $75,000, there's $1,200 was the first round, and up to just under 100,000 was the phase out, and that was doubled if you're married filing jointly. So when it's a refundable credit, it's either going to be excess cash, which would lower your tax bill, or it's going to be cash in your pocket that would increase your refund.
Okay.
The reason it's a credit is because the IRS has this year, I guess, 15 different credits, with 5 of them being refundable. The rest are all like the child tax credit, adoption credit, energy efficiency credits, those types of things that can reduce your tax bill, but not necessarily give you cash back.
Gotcha. So go ahead, continue.
Yeah, so one of the keys here is, A, did you receive it? How much did you receive? And B, if you didn't receive it.
Okay.
So if you received it based on your 2019 tax return, is it going to get adjusted for your 2020 based on your income levels? They're thinking that it's not going to be, but as we know with everything going on right now, things can change.
So when you mean that, so if you earned more in 2020, would it get adjusted down, or is that what you mean, or the other way around?
So if let's say you got $1,200 in based on your 2019 tax return, but your 2020 AGI is over, you probably weren't entitled to the credit. So I don't think they're going to be asking for it back because was not the intent of Congress. However, it's still a little bit of a vague area.
Okay.
So the IRS sent every taxpayer who received, they should have sent it to every taxpayer actually, a letter 1444. So if you received the credit, it should have the amount of the credit that you received. If you didn't receive it, it should say that you didn't receive the credit and that you can put it on your tax return.
Gotcha.
I would say half of my clients did not receive their stimulus check, including my parents. So that's the first place to start. The place where it gets, it's going to be a little bit of complications around filing is if you ended up in the middle. So let's say you come into my office, we're sitting down doing your tax return. You're like, I got a stimulus, but I don't remember what it was. Was it 500? Was it this? Okay. You made $80,000. We're going to have to go in and do the math to figure out, did you get 1,200? Did you get 1,000? What were you entitled to based on 2019's numbers? So it's going to be a little bit of an extra heavy lift. It is something that I believe the IRS will be following up on. So don't think you're just going to pull one over on your, kind of tax preparer and just say, I didn't receive it, now I want extra money. Because I imagine they're going to be checking this.
Fair enough. So that was the first round, right? And now we've had a second round that, if I recall correctly, was some maybe went out at the last week of December, some didn't go out to January. So how are those being treated? And does it matter whether it was sent to you in 2020 or 2021?
So under the bill that was signed on December 27th, it's all 2020. So, and under that bill, the IRS had to distribute the funds by January 15th. So, and they actually did a really good job of it. Between the commissioner and the Treasury Secretary, they got those payments out to the taxpayers, to the American people. So it's going on your 2020. Now, I don't have a crystal ball, but there are discussions of another payment coming from Congress, from the government.
As of the time of this recording, yes.
As of the time of this recording. So the question that is yet to be answered is, will a third stimulus payment be retroactive to 2020 tax return? Or is it going to go on 2021? And there's been no definitive answer from Congress yet. So that's something just to keep your finger on the pulse, so to speak.
Fair enough.
But the most important thing with the stimulus check is check your bank accounts that you got it and look for that letter. Look for the IRS is sending you that letter for a reason. It's going to help make filing your taxes a much easier process because you're going to put the right number on the tax return and you're not going to have to deal with a correspondence.
Very good.
Letters down the road.
Very good. Thank you. So amongst all the other emergency policy measures put into effect, there were other, such as, there were other measures in terms of allowing people to defer taxes by not forcing people to take RMDs, or avoid penalties by letting people take hardship withdrawals. How did that how does that work for those who needed to take hardship withdrawals? And potentially, what is your thought process on whether or not they might actually extend that to 2021? Because I know they haven't done that to this point.
So I'm not sure if Congress is going to extend it and make it available again. Something tells me they are going to hold off on the RMDs, but pulling the money out tax-free or borrowing it from yourself, essentially, from your retirement plans, I don't think they're going to. Now, if you took a hardship withdrawal and it was a bona fide hardship withdrawal, you have 3 years. Basically, you can spread out the tax consequences over 3 years. Great planning tip, right? So if you did take money out and it is recorded as a COVID withdrawal, you're not paying the 10% penalty, and you can, spread the tax hit, the tax consequences over the next 3 years. So that'd be 2020, 21, 22. That's critical. Now, you don't have to spread it out. So if you have the ability and things turned around for you, great. If they didn't, you are going to have to pay tax on that money. Mm-hmm. And I think that's going to be a surprise for some people. Mm-hmm. Because generally, if they probably took the money, they still need more help. And again, Congress is a funny institution.
Fair enough. Sure. So now, go ahead, continue.
Yeah, one thing I was going to just kind of bring up is I am concerned a little bit about, I haven't seen any COVID distributions yet from 401k plans. Mm-hmm. I am a little concerned about the coding on the 1099-R.
Okay.
And so what was it done correctly from the plan sponsor's end? Was it coded correctly?
From the plan sponsors, if it was done from a 401k?
Correct.
Any questions on that if it's coming from an IRA?
Well, again, whoever's administering the IRA, did they code it correctly?
Gotcha.
So that's the first thing. And then two, again, I haven't experienced this, but it's just forethought is, did someone take out money in anticipation of the hardship? And they aren't necessarily going to qualify for the hardship.
And have they set up rules for what that hardship might look like?
So were you quarantined or furloughed from, the business closing, reduced hours, where you're not allowed to work, your house was going to go into foreclosure. So it's a pretty wide net, mm-hmm. But again, it is a definitive net.
What about employees who were otherwise maybe were unemployed going into 2020 and now they wouldn't have the opportunity to find a job, or their job was supposed to be there and then wasn't, they basically, it didn't come through because of the hardship or because of the pandemic?
In the guidance as of today, there is no mention of if you were unemployed as of March 13th.
Gotcha.
Now, will the administrator of your IRA or your 401k, again, how they code it, mm-hmm. is going to be critical.
Mm-hmm. Understood. So, obviously, so that's interesting for individuals who are suffering and dealing with hardship and how that will look for their taxes for this year and for the next couple of years. One of the other things, you were talking about businesses that's been a lifeline has been PPP, the Paycheck Protection Program, and it's allowed many business owners to keep their businesses going and to keep people on payroll. But of course, one of the big portions of that was trying to make sure that these people get their loans forgiven or not have tax liability for receiving them. What's the process for these business owners to get their loans forgiven, and how successful have they been in that process in your experience?
So the first thing I want to say is I think the IRS is right and Congress is wrong in terms of recent what came out in the December 27th bill.
What do you mean by that?
So under the CARES Act, you received $100,000 in PPP money. The expenses, the money went out to pay payroll. Let's say you put 100 grand into payroll. That should not be a business expense because it was used with basically loan dollars that is going to be forgiven. That changed in the December 27th bill. So I think the original IRS guidance saying that those expenses were not going to be deductible was correct by the IRS. Congress went ahead and changed that. So it's a double dip for business owners. They get the free money, or what will be free money, and they're getting the business expense. So the first thing is there's another credit in there, the employee retention credit, or employer retention credit. That's going to play into how you calculate your PPP forgiveness.
Okay.
And it's an 8 to 24 week covered period. When does that start? When does that finish? That has been a moving target because when the CARES Act was written in March of 2020, no one thought New York City was still going to have the restaurant shut down in September, or not at full capacity. So the period has always been 8 to 24 weeks for what you're using the money for, so to speak. The key is that there's an additional up to $10,000 credit for retaining your employees that you're also going to be able to get based on kind of quarterly business returns. So that's one thing to consider for business owners with employees. Now regarding forgiveness, the SBA has it's the 3508, and there's an easy, there's a long form, and there's a short form. Essentially, the biggest factor is, did you get more than 150 grand in PPP money? Okay. So if you're over it, you fill out the long form. There's going to be a lot more documentation, things to look at. For the majority of people who got under 150 grand, you're going to use the short form and the easy form. So you get your payroll reports, you get a copy of your lease, you get your canceled rent checks, canceled utility checks. Combined all that. And that's essentially the documentation you're going to need to apply for forgiveness. Again, based on what 8 to 24 week period you choose. So we have a little bit more flexibility. It's not just the original guidance was 8 to 24 weeks from when you got the money. Now you could potentially be applying it to 2021.
Okay.
So one key factor in figuring out what is forgivable is, did you receive an economic disaster grant, which was $1,000 per employee up to 10 employees, and it was free money.
Right.
That reduces your allowable PPP forgiveness.
Well, that makes sense. Sure.
So if you're a business owner that got a $10,000 grant from the SBA and you had a $20,000 PPP loan, only $10,000 of it right at the start is going to be eligible for forgiveness. So you still have a $10,000 liability that you're going to have to deal with. And the key here is getting your utility checks, your utility bills together, getting your lease, which for some business owners is more challenging than others, and getting and getting the copies of those rent checks. The payroll report should be easy because if you're using a payroll service, those are readily available. Having that information collected for whatever 8 to 24 week period you're choosing and put it into a file folder and have it ready to go for when you apply for forgiveness.
And obviously the strategy for using that is to find the highest, I mean, assuming whatever most covers that or I guess the highest period of expenses within that 8 to 24 week period, I would assume, right?
Well, and do you have the ability to take the employer retention credit?
Mm-hmm.
Right, so you want to get the credit up front and then start the PPP timeline.
Gotcha. So that employee retention credit's new to me. Tell me a little bit more about that briefly.
So if you kept your employees on payroll, and even if you were in a down period, there's $2,500 a quarter per employee that's available as a credit. So if you had restaurants in New York City, obviously, if they kept some of their employees on during the second quarter of last year, they're going to be eligible for that. Right. So if you had a retail store that kept some of their employees on payroll during that period, they're going to be eligible. So you find the worst quarter and you work from it. You start there.
Fair enough. Sounds reasonable. So thank you for all that. I know it's a complex situation, and I'm sure counseling people through that going into this season or on an ongoing basis is certainly going to be a somewhat challenging part of what you're doing. So, we started at the top and really talked about a little bit about the shift in tax season. So obviously last year, starting in March, the crisis really hit when tax season would have been peaking. Obviously, the IRS recognized this, and all the jurisdictions said, okay, we'll have a mandatory filing date of July 15th, not only to allow people to get their stuff together, but also to allow people in your business to be able to safely do all the work they need to do. And you said you think that's likely to happen again. So what's your thinking on that? And how long will people have, and why, even though it hasn't been announced as of recording?
So here's a little unknown fact about what happened last March. March 13th, the national emergency goes into effect. The Treasury Department has the ability to move the filing date for any reason they choose. However, the payment date has to be done by Congress. So you would need an act of Congress to move the payment date, except in a situation of war. So later in the month of March, former President Trump signed into the Defense Production Act, which essentially allowed Treasury to move both the filing and the payment date, which some of my clients got interest payments. They were getting checks for $2.72 on their refunds because of this unknown fact, this little obscure detail that kind of got glossed over at the time.
I think I got a $5.53 check from the state of New York.
Right, because there's all sorts of obscure laws and reasons for things on the books. Regarding the date itself, short of us going into another shutdown, I don't believe we're going to see the administration try to push out the filing date. And I think while it's going to make a very condensed tax season, because as the date of recording is February 12th here, it's the start of tax season. April 15th not only is the day in which you file your tax returns are due, it's a certain level of normalcy. And I think by pushing that out again, psychologically would actually say we're not going to get back to normal.
Interesting theory.
So that's just, again, short of some other bigger issue that hasn't arrived yet, like shutting everything down. I think it's still going to be payments are due and your tax returns are due on April 15th unless you have a valid extension.
Fair enough. So, we've talked about PPP, we've talked about the stimulus checks. What other tips or strategies can people use filing their taxes this year to either lower taxes due, increase their refunds, or avoid other pitfalls that might, they might normally do in more normal times, or are particularly special to the times that we're in?
So, as I say to my clients, planning happens in the current year, not after December 31st. So, come to me in July, August, September, October, November, when we have time to actually sit down and strategize a plan that makes sense for you.
Mm-hmm.
That's the first thing. The second thing is, we talked about the IRA or the 401k distribution earlier. If you know you're going to have this potential tax bill for the next 3 years, how do we get ahead of it? Right? Do you have extra money? Can we, if you're a business owner, is there a way to either consolidate assets? Is there, right, some sort of business move, something within the business that we can do to generate cash to make sure you have it, pay the IRS? For an individual, is it knowing that you have to put in an extra $5,500 into an IRA? Right? No, right. In addition to,
Mm-hmm.
is it, or just knowing, hey, I'm going to have another $7,000. Let me start putting money away now today because I know this bill is coming due. But the key with planning is to be ahead of it, not behind it.
Of course, that makes sense. And certainly, I thinking about that, and I know one thing that I'm dealing with that's a little bit different is I'm dealing with clients with student loans who are on income-based repayment plans. And if you look what that looks like, they're going to have a large tax bill due once they, reach their years, and trying to get ahead of it and start planning for it now, even something that's 10 or 15 years away, because you see the tax hit that's going to come out of it. So I certainly understand that.
Well, here's an interesting conversation regarding student loans. President Biden has floated the idea of an executive order taking $10,000 off. Members of Congress want him to do 50. Is that going to create a tax bill? Cancellation of debt? I don't know how they're going to handle that.
I guess it depends on, well, you're the tax law guy. I guess it would depend on how the method, right? If it's executive order versus.
Right. And so, right. So for somebody to have, and I guess if you had $10,000 of student loan forgiven, and you get a 1099-C for that, and you're at a 20% tax bracket, pay $2,000 to get rid of 10. Not a bad deal, but again, watching the news and figuring out, hey, this is going to be a hurdle.
Right. And then you have the question of if you do that and allow it, do the people who you're trying to help by getting rid of the 10,000 or any of it have the 2,000 to even pay?
Right.
Because that, I think, is an issue as well.
Yes, and my gut tells me starting Memorial Day, savings rates are probably going to start to drastically go down.
Mm-hmm.
As we start to open up again, people are going to, there's a lot of pent up demand in the system that's going to be fulfilled.
Mm-hmm. That certainly makes some sense. So is there anything else? I mean, I know that, there are the standard things about being able to make contributions for last year to IRA plans or Roth IRA plans. Anything else that somebody could do now to reduce their tax liability for 2020 that may not have been done?
you have the various deferral programs, tax deferral programs. But when the calendar year closes, it's hard to go back and do anything.
Mm-hmm.
So, right, that's why you see a lot of charities get checks in December because of charitable contributions. It's something to, again, to get ahead of it, not play offense, not defense with this.
Sure.
And there's really not a lot because we're all cash-based taxpayers. So we all work on, December 31st is the year end.
Mm-hmm.
There's not a lot other than the savings credit or the IRA contribution that you're allowed to do.
So if people have missed that opportunity, what other things do you typically tell people in October, November? Maybe we'll have you back. What other things do you tell people to do once they're getting to the end of the year to think about to get themselves ready for the following year?
The first thing is take a deep dive into cash flow. Right. So if you're living paycheck to paycheck, you may find it difficult to put money aside. So that's the first thing. What are your expenses? What's going on? What can you either stop doing or defer taking advantage of, like a December vacation? Mm-hmm. So first is making sure we have the cash to do this thing. 2, fund your retirement programs or your IRAs as early as possible. Right, get that on the books. So the cash is already gone. It's already being invested, working for you, rather than having it showing up on April 15th and having to have a bigger hit. There's also, if you qualify for the health savings account, can you max that out? Will your company, will your healthcare, whoever administers that, will they allow you to put additional money into it later in the year?
Mm-hmm.
Right, because that's a great way to build savings for your healthcare costs. So, and then the biggest thing of planning, or the things that we don't see or talk about really, is, are you buying a house? Are you selling a house? Are you buying a car? Did you trade your car in? Under the Tax Cuts and Jobs Act, there are no more like-kind exchanges on cars. So you actually have to take figure out what the tax basis of your car is, and you may have a gain or a loss on your car.
Interesting.
So what life events are happening that we need to look at and address and talk through so we minimize the experience on April 15th? I know I have not met a client that likes getting a phone call saying, I got to wire $100,000 out of your account to pay your tax bill.
Oh, well, yeah.
Right? I haven't met those clients. However, if they know in October it's going to be $100,000, it's much more palatable.
Sure.
And a lot of the majority of tax bills from my clients that I've seen is because they did not stay in constant communication with me. They sold the house. They didn't tell, right? We didn't talk about what the cap gains were going to be. Right? Cars, other assets, whether it's artwork or jewelry, things like that have to be reported. And they don't talk about it, and then it's like, oh yeah, I didn't tell you I sold this.
Right. And that's part of the planning process, right? Even for me, when I'm meeting with clients, it's like, I always have to ask them when I do an annual meeting, did you sell anything? Like, whether it's a house or, like you said, like a ring, some sort of jewelry, something like that would generate sizable cash flow because it's a potential tax hit.
Well, and then what's great about where you come into this process is you have their investment piece. And by working together, we're able to see a whole picture of what their financial life looks like.
Sure.
So because they sold the rig and they have a gain on it on one side, do they have other losses in their investment accounts that we can offset those?
Sure. And
And
not last year, but for the most part anyway.
right. And isn't that incredible, with everything going on? I mean, it doesn't seem like there's a down day on Wall Street.
Yes. Famous last words. Trust me.
So the key here is plan early, plan often, and minimize your tax bill at the end of the year just by knowing what it's going to be, or
Sure.
have an idea of what it's going to be.
Very good. And just before this, obviously we've talked a little bit about, well, obviously a lot of this is legislative, right? We've talked about, how the new administration and the new Congress will affect things. How likely is it that you see major changes to the tax code going forward? And is there something you're recommending to your clients to kind of get ahead of what you think will happen? So like, for example, last year, right, like in 2020, I thought, I looked at all the extraordinary measures that were happening in Congress, and I talked to some of my clients and said, you know what, you should really consider a Roth conversion, even if their income was very high, because I thought, well, okay, you're buying the government out of, their share of your retirement account now, and that's probably to your advantage. So that was my opinion, but nonetheless, I don't know if, and a couple of my clients did do that because they're young and have a lot of time to make that money back. But I don't know what your thinking is.
So the Roth conversion's one. I'm curious to see kind of how Congress plays out here with the stimulus bill that President Biden's pushing forward on.
Okay.
My guess is that there's probably going to be 800 or so pages of tax law in there. Some of it retroactive, some of it forward. And then I do believe that some point in 2021 or early 2022, there will be his version of a tax bill to further add, stack on top of this house of cards, so to speak, that is the Internal Revenue Service. The big piece that's in there that I see that's going to have for people that have a considerable amount of assets is the lifetime exclusion. The talk on the street is reducing that from 11.5 down to like 3.8.
And this is on estate taxes, right?
For estate taxes. So that drop of nearly $8 million, but then not giving the beneficiaries a stepped up basis. So talk about the double whammy.
Oh, yeah.
Now, where does that fall into and what is the timeline for that? Your guess is as good as mine. I do think it's going to be part of some overall tax bill that we're going to see out of the administration here within the next year, because they've said they're going to raise taxes on corporations. They don't want to wait until 2025. So time will tell. I think there's going to be a couple other sneaky things in there that people aren't expecting.
Mm-hmm.
But anybody with investable or with a considerable amount of assets where they were planning on the lifetime exclusion to basically shield some of those needs to give that some considerable thought about how do they pivot if this becomes law.
Fair enough. Fair enough. I mean, I don't want to go too far down the weeds here. Obviously we had, like you mentioned, the Tax Cut and Jobs Act a few years ago that doubled that exclusion, and this would obviously bring it back to lower than the prior level if it's at where you put it. Does that mean some of the old strategies that became less valuable in the last few years come back into vogue? I mean, I've sort of thought that would happen even with the Secure Act, that would have occurred. You know,
The irony of going after the estate tax in general is it's Form 706. When someone dies, they fill out a Form 706 for estate taxes. There is, for every 1,000 set Form 706s that are filed with the Internal Revenue Service, 6 end up paying tax. And that was pre-Tax Cuts and Jobs Act. So there's going to be a lot of talk around something that's only going to impact a very few people. So it's going to be interesting to watch and see as it unfolds. And when I think about estate taxes, I think about George Steinbrenner.
sure.
Right? I mean, he passed away in July of 2010, and
Yep.
it just so happened to be the year where there was no estate tax.
Yep.
So I imagine that this administration, as well as future administrations, are not going to do away with taxes. They're just going to keep adding to the complexity of it.
Fair enough. And, you know, I know we could get into a lot more with the Secure Act, which kind of got overlooked with COVID last year, but we'll save that for next time we have a conversation. So give me, Ryan, how can people contact you?
Great question. So my email address is rmitchell@hobokentax.com. The phone number is 201-266-0025. And my website is hobokentax.com.
Great. Thanks, Ryan. I want to thank Ryan Mitchell for joining us today on Discuss with Russ. You can reach me at russell.rivera@voicewealth.com, or give me a call at 646-630-0980. For those of you watching this on YouTube, thank you. For those of you watching it through our monthly newsletter, thank you as well. You can always view this and other recordings from the Discuss with Russ program on the Voice Wealth Management YouTube channel, also on our website at www.voicewealth.com/blog. And watch out for our next episode, which will come out at the end of March and be in our April newsletter, which will focus on cybersecurity for individuals and businesses. Again, thank you for joining us. And remember, it's your money and your future, and we can be your partner and your voice. See you next time.